Michael Carnevale is branch manager and financial advisor. Securities offered through Raymond James Financial Services Incorporated, 400 Southbridge Street in Auburn, Massachusetts, 1-800-657-9126. A member of FINRA SIPC and are not deposits, not insured by FDIC or any governmental agency, not guaranteed by Webster 5 Cent Savings Bank, and subject to risk, may lose value. Webster 5 Cent Savings Bank is not affiliated with Raymond James Financial Services Incorporated. The information contained in this report does not purport to be a complete description of the securities markets or developments referred to in the material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Any information is not a complete summary or statement of all available data necessary for making an investment decision and does not constitute a recommendation. Any opinions are those of Michael Carnevale and not necessarily those of RJFS or Raymond James. Expressions of opinion are as of this date and are subject to change without notice.
Clipboard's up. Come on, clipboard's up. This is Richard Morco and Mike Carnevale, and this is Conversations With, where Mike will set us right about the economy. We certainly hope, because somebody's got to do it. So, Michael.
Yes.
It's been, other than politics, it's been not the most wild month.
No. But again, you know, if you looked at the political side, politics, and didn't know what was going on with the stock market, you would never guess the stock market has done what it's done. June historically is not a good month, but most recently it has been pretty good. 2024 was no different, was up 1.2%. Normally June is ranks 10th of the 12 months historically, but 7 of the last 9 have been positive. And what do you mean positive? The market was up in June 1.2%. Well, don't you see what's going on in the political landscape? Oh, you know, this is going to really be bad. I'm getting out of everything. The stock market, you watch, it's going to tank. Now, people have been saying that for so long. It's like you got to give it up because you've left behind. Had you taken the political stuff for you know, on face value, you would have missed a big run in the market. And you know, I think it's going to continue.
Okay. Any reason? Just you know, you could make the case that well, everybody's concentrating on the political circus.
Yeah.
Well, other people are planning on concentrating on getting work done.
Right.
So why you say continue? I mean, one month can be different from what? Yeah. I know you always say sell in what month you say sell in
May and come back in
so
November.
That could be just, you know.
That could be. I think a lot of it has to do with not with what people feel or think. I think if you take a look at like 3 or 4 basic things like inflation, the jobs market, interest rates, I think it's all heading in a direction that is not going to lead to a big drop in stock prices. May not lead to a big rise either, but I think, you know, we're going to see a big drop. And there was a Canadian firm who made a splash last month, said S&P is going to drop 30% between now and the end of the year. You know, so you say, okay, well, for somebody to say that, first of all, that's, to me, it's kind of like, well, if you're trying to grab a headline, you did, congratulations. I don't know how somebody can predict something like that. But then you go and you take a look at, well, what firm is this? What's their track record? Who are they? And I'd never heard of them, so I said, yeah, I've never heard of this company, this firm. Turns out they're based in Canada, and okay. Yeah, they grabbed a headline for a day. And you know, you get people calling up, oh, did you hear? What? Oh, that the market's going to no, I didn't. Who said this? And they rattle, oh, I don't know, this firm said the S&P is going to drop 30%. Okay, maybe, but I wouldn't bet on it. And I do it solely based on some economic numbers, number one, and those 4 technical indicators that I would look at.
But you always, since I've known you, you've always been stay with it, don't rush off, and you know, put everything in the gold. You know, go buy a gold mine or something. You've
Right.
never been that guy.
No, because
And generally speaking, as they say, the world doesn't end every day.
right.
So, as we, there are bumps in the road.
Always will.
2008
Always
was,
are.
was horrible,
and
but the
the-
world did not end.
Right. And the reason I've been positive for quite a while, a number of years anyways at least, is based on those numbers, based on the technical indicators, and based on some economic data.
Well, as a kind of a little departure
Mm-hmm.
today, I mean, you should take each of the technicals and give a 2 or 3 sentence explanation to the people at home as to what they are and why you find them important.
Okay.
And then say what they are, because it's worth knowing.
So there's a slew of these technical indicators. There's probably hundreds of them.
Yeah, but you got the ones you hear. You know,
I look at.
your,
You want to look at.
your faves.
You want to look at. Maybe 4 of the major ones
Yeah.
that you might hear someone other than us talk about. And the first one is the 200-day New York Stock Exchange moving average. And why 200 days? Because 200 days is about the amount of trading days in the year. Monday through Friday, right? 5 times 52 minus holidays, you're around 200. The New York Stock Exchange moving average takes a look at every stock that's listed on the New York Stock Exchange, which is historically the major index, a major exchange. And you see, well, where is each of those New York Stock Exchange listed stocks trading today compared to where they were at the high point and their low point? And what can that tell you? Well, that can tell you where we are, where things have been. For instance, if you saw most of the stocks trading above their average price for the past year, you'd say, okay, prices are probably high. Odds would favor they may start to go down a bit. If you saw, so I may hold off before I buy. If you saw the average, most stocks were below their average price over the year, that would tend to mean they would be on the low side of the past year. And maybe that's when you want to buy. The buy low, sell high. And then
Could you say that again?
buy low, sell high.
Ladies and gentlemen, I think we've really got something.
I don't know if this is turned on,
Oh, darn.
but this is.
All right.
And so you take a look at what that percentage is, and that percentage itself doesn't mean anything, but you have to compare it to something. So, okay, let's see where it is today. Where was it a month ago? Is it lower today? So if it's lower today than it was a month ago, that'd probably tell you, well, prices have probably dropped. Odds would favor, and that's all these are is odds. Odds would favor maybe things start to go up again. That's just one item of, 4 that I would look at, but one item of many that can give you an overall view of where things are today compared to where they were at some point in the past. Usually it's a month ago.
Well, I say there's 2 things here now. I asked for a 1 or 2 sentence explanation, and that was a good 5 paragraphs.
Okay.
And
All right.
and we're not complaining.
We'll make the next one shorter.
And I'm going to come to a conclusion at the end of this
Okay.
that I think you're working towards. Go ahead. Go ahead.
So the stochastic oscillator is another one, the volatility index is another one. This measures how stocks have been trading in a shorter period of time. So it measures, obviously by its name, volatility, the swings. So when things are really moving rapidly, people tend to be more, take notice, maybe a little more concerned. When things are not moving rapidly, people become more, calm. You want to see the opposite. So you want to see, when do you want to buy? You want to buy when everybody's worried, when there's a lot of volatility. When do you not want to buy? Well, when there's less volatility. And volatility has been very low, they call it the fear index, for a very long time, meaning that the level of fear in the market that prices are going down is very low. That's a negative. Then you got the oscillator, which...
That sounds like a piece of medical equipment, actually.
And the word before that is even more medical.
Oh my gosh. Get that stent in there.
That really takes into account the price in relation to its support level, meaning its recent low level, and its resistance level, its recent high. So if something is at $10, and well, what's the lowest it's been in the 5? Okay, 5 would be like the support area. What's been the highest? 15. Okay, 15 would be the high. Where are we today? Well, we're at 10, so we're kind of in between, right? That's another one where you want to see it sort of in the middle to lower. The number in the middle to lower, which is about where it is right now. The last one's a catch-all one, fear and greed index. This takes into account a lot of technical indicators, not just the 3 that we look at. And this tells you whether there's a lot of overall fear in the market or not. And again, you want to see a lot of fear in the market. Because when do people become afraid? When things aren't going their way. So you bought something at $10, it's 20, you're really not worried.
No.
You bought something at $10 and it's 5, you're worried. So you want to see the fear and greed index to be very high. It is on the high, a little bit on the high side now. At least it's in the fear category.
Une question, as they say in France.
Go ahead.
You talk about this, but I've also gotten the idea from you that one should more or less stay invested and just not jump in and out of the market.
Right.
How does that fit in to the Carnevale philosophy of just staying in the, adding to your retirement fund,
Okay.
but basically staying with the program?
Right. So, a lot of these financial types say, oh, well, you have to be in it long term.
You wouldn't be a financial type.
On some days. On Saturdays and Sundays, Monday through Friday, no. But, these pundits, shall we say, oh, well, let me show you my chart, and it shows that, well, in 1950, if you put a penny in today, you've got this, you see it go, and immediately your reaction is, oh, wow, hey, that's great. It goes like this, straight up. But it doesn't. It may start here and end here, but it's like a wave. So these technical indicators kind of take the emotion out. It's sort of like I would look at it as, look, I'm not going to get excited if it snows in January, right? I would get really worried if it started to snow in July. So if I look at these technical indicators and they're saying, wow, market could go down a bit. If the market goes down a bit, you're not surprised. So you tend to stay in. It takes the emotions out.
Well, I tend to think the idea of snow in July is kind of flaky anyway.
Well, actually, it would be a,
You see,
a
watch
relief
this
today.
guy fight the smile.
It would be a relief if we had it today.
Oh,
You know.
well, okay, you're not in the worst air-conditioned place.
I think we're in the next to worst, though.
Oh, okay.
But no, so those technical indicators, they try to force you to take the emotions out. You know, because human nature is all or nothing, right? Well, I'm either going to do it all or I'm not going to put anything in, right? I don't know how many times you heard someone say, well, you know, maybe you should do a little bit of this, and the reaction is, well, if I was going to do it, I'd do it all. And these technical indicators force you not to do that because they take your emotions out.
Can I ask you about your clients, and do a lot of them come and say each month, hey, what's the stochastic oscillator?
None of them.
So most of them are just going along because they've been with you, they know it's,
Right. I mean, I may talk to them about these things, but nobody's asking about them.
they've been around the block.
Yeah, in other words, you know, oh, well, you said that, you know, this could happen. Yeah, it kind of did. So nobody's surprised. And that's the key. Because to get the return, to get the long-term return, you have to be in it long-term. And the only way you can be in it...
Whoa.
Yeah,
You get the long-term...
to
you
get
gotta
the long-term,
be-
you got to be in the long-term.
Okay. Whoa.
Now, you'd be amazed at how many people don't think that. Well, how can you not, right? It's like, well, I'll get in, but if it goes down, I'm getting out.
Well, you got to stay in the short term to get the long-term reward.
Correct.
Or am I a long-term to get the short-term reward?
Right.
Okay.
So the key is to take the emotions out of it. And how do you do that? To get an indication of what is likely to happen. It may not, but if it did, you'd say, okay, like last month, you know, June was historically a bad month. So if the market went down a little bit, yeah, you wouldn't get too excited, right? And you didn't get out, even though it was a bad month. You know, you should have got out because it ranked 10th of 12. Well, had you done that, you'd have missed a gain of, at least for the Dow anyways, of 1.2%. So you wouldn't have gotten out because of those technical indicators.
Now we move on to the major news.
Well, the Fed had a meeting. They decided not to do anything with interest rates again.
And I know Mr. Powell is saying maybe
Right.
September.
Maybe September. This, you know, again, the same, more of the same. They're concerned about inflation. The economy looks still pretty good. And they said they've hinted they may start cutting rates in September. You know, some say, well, that's close to the election. Well, you know, it depends if...
Do we want to put, does anybody out there want to put money on whether we do see a rate change?
Well, right now, if you look at and I would look at the Fed funds futures because they kind of give an indication. And there's a better than 50% chance right now that they will cut rates in September. They're not going to do anything at the end of this month when they meet. No. And then the next month is the beginning of September. And some say, well, we got an election coming up. But who knows what the polls are going to look like at that time. If the polls look like there's a likely one side is going to win, then the Fed may do something.
Well, historically, the Fed has, on occasion, favored one party over the other.
Right.
I'm not going to comment further.
Right. Well, I will say this, that the Fed and Wall Street in general is Democratic. Now, a lot of people find that hard to
As
believe.
they say in Boston, not a wicked shocker.
Right. So there's no question Wall Street is would love to see the Democrats win everything.
I notice here is there's no mention of Turkey.
No, they were quiet.
Which has always
they
been
were
our
quiet. I
favorite.
know that was our favorite country, but they've gone quiet for some reason. And there were no change in interest rates in the UK, which wasn't a surprise because they had an election pending. But Canada cut rates, and the European Central Bank cut rates, and Switzerland cut rates again for the second time in a row. So you see that the world is moving toward lower interest rates, and eventually that will force the Fed to cut rates, whether they really want to or not.
Well, probably, but the most interesting bit of information in this page is NVIDIA.
Yeah.
I know you hope you people know that's the place. That's the company that makes the AI chip.
Yep.
The big AI chip. It's changing the world. Is the most valuable public company in the world. Its market capitalization is larger than the entire stock market of UK, Germany, or France.
Yeah. Amazing. The stock was first issued in 1999 at $12 a share.
Why didn't you call me at that time? And how much did you invest in it?
Zero.
And
Zero.
probably just about everybody.
But had you bought 100 shares and held it through stock splits, you'd have not 100 shares today. You'd have 48,000 shares. And it'd be worth $6.5 million on a $1,200 investment. Now, I'm sure there's a lot of people who did do that. But, you know, a lot of times with this technology stuff, at least from my own thinking, you got to understand it.
And
And
I certainly
do not.
don't.
You know, somebody could say, you know, back in 1999 or 2000 or whenever, say, oh, you know, this NVIDIA, oh, they've got this chip, it does, it's going to do this, that. And if you're not that deep into technology, you can't understand it.
Absolutely. It went way beyond me and you. However, the people who knew what they were talking about are feeling pretty chipper now.
Yep. We do have a couple of people, I think 3 people, who were in the tech field, who knew it. And, you know, well, you know, you look at their statement and it's like monopoly money with what happened. But, you know, they were in the field. They knew.
They'd have to be.
Otherwise, you know, it's like, they do what? What was the name of the? I forget it.
Well, I knew a family knew somebody in the early 50s. They had a little extra money. They went down to a broker and said, what do you got that's worth? I said, Polaroid. They did well. Mm-hmm. They did really well. Where is Polaroid today? Mm-hmm. Oh,
who knows? Can't find it.
It's sort of the Kodak of instant pictures.
Yeah. Yeah.
All right.
Yep.
Oil in the low 80s.
Yeah, it's gone
It
up
was
from.
in the 70s.
Yeah.
When?
Yeah.
Yeah, okay. And, okay, now we get to the science. I'll let you talk about that.
Yeah, I mean, you know, technical indicators aside, that's all great, but the thing you want to focus is, I always say, you know, if you're looking at the newspaper, if you can find one, if they're still printing them, you know, you probably do better looking at the sports page than you do at the business page. Celtics won their 18th championship. The previous 17 times the Celtics won a championship, the following year the stock market was up 13 times for an average gain of 11%. And the last 6 Celtics championships have been followed by a stock market that went up the following year. You have to go back to 1969 when the last time the Celtics won a championship, and the following year the stock market went down.
I remember it in the dorm.
There you go.
There were a lot of less than sober people that
Okay.
night. Okay, inflation. Is this unchanged? Or
For the month.
For the rate of, or is it the
Rate-
rate of increase?
No, there was no change. The
change.
prices were the same in May as they were in April.
Yeah, that's a victory.
3.3 for the past 12 months. That rate is down from 3.4 in April.
So it was still inflation is going up. It's just the rate of inflation.
Right, is going down.
Okay. I heard an analogy that you go into your doctor and you say, he says, you're up 10 pounds, you got to stop, you got to lose weight. He says, next month come in, up 4 pounds. Wait a minute, I'm up 4, no, you got to lose weight.
Yeah.
So this is basically what is happening here.
Yes.
And we don't have to belabor it because I belabor it with you every month.
Correct.
All right.
But the alternative is the rate going up, the pace going up, which is what you don't want.
Oh, you like this. You love this.
Yeah, as long as the rate is going down.
But the inflation is increasing.
Yeah, well, I think it's always gone, unless you get into like a deep recession, right, or a depression. Then prices may fall, but you really don't want falling prices.
Is it because inflation goes up because of prosperity, or inflation goes up because of the Fed?
Well, probably both. Probably both.
Okay. All right. Leading economics indicators. May was down 0.5%. 10 components give a snapshot of the economy. Last 6 months, down 2%. Prior 6 months, minus 3.4%. 7 of the 10 components were negative for the second month in a row. Biggest component at 28%. What's that? Work week?
The length of the work week.
Length of the work week.
Which is it was a bad result, but there were some items in there that give you some hope for that maybe we can get out of this. It's going to be tough, but we've now had 3 straight negative months. So if we have 3 straight negative months, that just increases the odds of a recession. We had umpteen, I forget, I don't know, 20 something. Then we had that one positive in February, which was a fluke, it looks like, because now we've had 3 negatives in a row.
Okay. Jobless claims, 233,000 versus 238 a year ago, 4-week average. 236,000, 250,000 hurts the economy. So we're okay.
And the big thing about that is, before we just fly by that really is impressive because there's a lot more people in the job market now than 5 years ago, 10 years ago. So that just means if there's a lot more people in the job market, there's a chance a lot more people who become jobless. And that's not been the case. So that's a good sign.
The non-farm payrolls up by 272,000.
Yep.
41st straight monthly jobs gained.
Yep.
Better than April, which was smallest in 6 months.
Right.
Manufacturing gained jobs for the second month in a row. Labor force fell by 250,000. Wages up 0.4%, 4.1% over the past 12 months versus 4% in April. Unemployment rose 0.1 to 4%, highest since January 22nd.
Mm-hmm.
All right. And I brought up some things
Yes.
for you to talk about just for,
Do we have any time left?
yes.
Oh, jeez. We went too fast, but go ahead.
You stretched it out.
Yeah,
Anyway,
you read my mind.
foreign-born workers, this is a Michael Shedlock, who writes on economics, wrote that foreign-born workers provided over 100% of employment gains since a year ago. Why? Well, how can, so if it's 100%, how is this any kind of victory?
Well, again, I think it's always been the case that foreign-born workers make up the bulk of jobs.
100%.
Yeah, see,
That's
Yeah, see-
insane.
yeah, I don't believe that
You don't
because I don't believe anything is 100% of anything.
Well, okay.
I mean, I think it's So if every job that was created, every one of them went to a foreign bond, number one, I find that hard to believe. However, I mean, a lot of these are lower level jobs, which tend to be the jobs that maybe someone who doesn't have the skills to get a higher level job. Now, that could be somebody who's come from a foreign country that might not have the educational level that would allow them to
So
get
you're
to.
basically now saying that it's lower level work, lower level jobs that are out there.
Yeah, I think
So anything technical, anything really good job, we're not getting.
according to that, we're not, which I
No,
find that,
no, that didn't even say that. That didn't say that it was subcontinental quotas. It didn't say it was.
okay.
So it didn't say anything about the skill level. You said the skill level.
All right. Well, I think it's certainly not 100%. I mean,
Okay, you disagree with this article.
yeah, I think it's a headline.
All right, the other one, job openings unexpectedly surge, driven entirely by government jobs.
That I
So if that's true, the cheery statistics you have
Yeah.
are not.
But I think that's also a false statement, false report. In other words, that's saying job openings surge driven entirely by government jobs. Well, in June, the most jobs created was not in the government sector,
How do you know?
based on the employment report that showed what it was healthcare that created the most jobs. Government
Most
jobs.
of healthcare, a lot of healthcare is government.
Right, but healthcare, government jobs was second.
What?
Government jobs was second.
And what was the first?
Healthcare.
Healthcare.
And social
A lot of the healthcare is
Oh,
government.
yeah.
How do you know what level of healthcare jobs are not government?
You don't know. But
But you don't buy this.
I don't buy these any headlines, that say entirely or over 100%. To me, that's like,
No government statistic, therefore, is trustworthy.
oh no, I don't think these are government headlines.
No, they aren't. But,
Right.
But they're the headlines aren't.
Right.
But they're extracted from government government reports.
I look at these headlines really like the headline that says the S&P 500 is going to drop 30%. It's to grab a headline.
That's a speculation.
It's-
That's not a report.
Yeah, I'd like to see, and I looked at, I tried to find this other than the story, and you couldn't find, like,
On the job openings one, you found no statistics?
no. The only thing I found was June 1 month. And I said, oh, well, okay. They're saying entirely,
There was much more to that in
entirely,
his report.
so then you got construction, created 27,000 jobs. Leisure contributed 7,000.
And that's the one, you got that from I gave you the website.
No, I didn't get it from that. I got this from the employment report.
You know, they always update those and
They revise them. They can be most likely they're always revised.
And we've come to the end of what we can revise. It's telling me over there.
Okay.
So I want to thank Michael for coming, and
Saved by the clipboard then.
we really are working with these clipboards. He's got a way to go before he really.
Yeah, not a master yet.
You start slow.
Of course. Of course.
You'll get it.
Yeah, sure.
So, this is Mike Carnevale, Richard Morco saying thanks for stopping by.